Hello and welcome to Acclime's podcast series Advancing Vietnam with me, Vlad Savin, as your host. Throughout the following episodes, we're looking to answering relevant questions about doing business in Vietnam. What are the opportunities and challenges faced by investors entering the market or existing players in major industries? We will seek to understand the business environment from a cultural, local mindset and how to deal with compliance from an international perspective. What are the major risks faced by businesses active in the region and how to overcome them? We will dive deep into the compliance environment in Vietnam, discussing processes and procedures, changes in laws, latest official updates from the authorities, and financial governance planning for businesses active in Vietnam. We at Acclime consider compliance a major asset for foreign investors operating in Vietnam. We emphasize this aspect when speaking with our clients, and we make sure they understand the significant benefits of being compliant. In this episode, I'm discussing with Matthew Lourey, managing partner at Acclime Vietnam, about foreign providers of digital products selling into Vietnam, looking at the broad digital media spectrum. We will seek to explain what are the newest taxation compliance provisions in Vietnam for these entities and delve into the efficient structures that can be implemented in country for an effective revenue and tax strategy. Matthew, welcome to our new episode of Advancing Vietnam podcast series. Happy to have you here for another interesting topic.
Thank you, Vlad. I'm looking forward to sharing more about the subject, as taxation of foreign digital products in Vietnam is definitely topical, and these new laws do make significant changes to foreign operators both in and outside Vietnam.
Matthew, the most recent decree number 126 issued in November 2020 with effect in 5 December 2020 refers to several tax provisions which apply to foreign businesses involved in online commerce in Vietnam. But before we go into details, can you tell me how did foreign digital businesses operate in Vietnam until now, and how was the government monitoring their structures and taxation provisions in particular?
But it's interesting, prior to this decree and the law that we'll get onto shortly, there was a lack of guidance. So you found that digital providers were approaching foreign contractors' tax as a taxing mechanism if they were asked, or they were being untaxed. You had providers such as, when moving into market, Uber and others that were foreign digital, getting money, receiving money offshore, were simply doing what they wanted and then negotiating with the authorities to develop a tax structure that both parties would agree. So it was quite a blunt instrument. And the whole reason we're now in this discussion is that there's now clarity and we move towards a much more certain structure. I would just say also that the businesses having to register their transactions with a foreign digital provider and deduct foreign contractor tax was cumbersome. And there was no clear, simple mechanism in the past. So this movement we have now will give clarity. And so I'm excited of what this will bring to us in the very near future.
Okay, let's go first back in June 2019 when the new law of tax administration was passed. Did companies take certain steps to align their cross-border structure with the new law?
So the Tax Administration Act 2019, which came into effect on 1 July 2020, is the foundation of what we're talking about here. It provides a structure for taxing foreign digital products in Vietnam and a mechanism to do so. However, until the Decree 126 came into effect on the 5th of December, there was no actual mechanism to follow. So many were anticipating, many providers were adapting. We had lots of inquiries from international providers about how to be compliant, but it was not until this Decree 126 that there was a mechanism to implement the law and the procedure for foreign registrations or taxation or the banks, etc. And there are a number of drafts about the procedures and processes between the law being issued and now. Normally, you'd expect a decree to be available on launch date of the new law. There wasn't, because there was debate, there was discussion, there was responsibilities. Can banks withhold payments, etc.? And there was a gap. So this almost, just over 5-month gap between a law being in place and no ability to implement it versus this decree has, provided planning opportunities, but not that much to be honest.
What does the Decree 126 state, and what are the immediate requirements for foreign digital businesses operating in Vietnam's borders?
Okay, from a digital product provider, Decree 126 now states that if the government deems you to be a provider selling products into Vietnam and puts you on the list of foreign providers, then that list means that banks must deduct, any bank payments must deduct VAT as a domestic sale, so you are effectively being registered as a domestic seller. It requires you that if there's payments by credit card, the bank must list them and report to the government of all the transactions that are occurring. So there's now a domestic record not only of taxes being held from payments from bank accounts, but credit card transactions. So they know the full scale of the business in Vietnam. That's the first requirement. And there is the option that you can register with a tax code, a Vietnamese domestic tax code, so that you can be compliant in country. And this declaration of taxes, this self-monitoring is what's intended out of this, so that companies, foreign providers, don't get named and shamed. They actually have a mechanism for providing, and it doesn't prohibit. There's no prohibition in there. This is a mechanism for taxation, and it doesn't stop the old foreign contractor tax, but it does mean that if you're deemed to be a provider of digital products, you're now deemed to be a domestic transaction and deemed to be selling it domestically for domestic consumption for the purposes of taxation and VAT.
Can you clarify again, what is the goal of this decree and law, and what is the government seeking to achieve in long term?
Yeah, so it is tax compliance. It is tax recovery. So a significant amount of foreign transactions, as many governments around the world, this leakage, this inability, so both physical imports, taxing imports, and many countries have changed the de minimis test and the low values for imports for duty-free or VAT-free. This is the same in a digital sense. And a lot of countries have been doing this recently to make sure that sales in the country that are consumed domestically are taxed as if they were a domestic sale. And when you've got the online world, borderless transactions on internet's made that harder. So this is the government's grab to get that taxation. They will use it with other tools, cybersecurity law. They'll use other options with bank withholding and name and shaming lists to get there. But ultimately, it's about tax revenues and ensuring voluntary but ensure compliance with the collection of tax revenues in Vietnam.
What about the cybersecurity law, which aims at data protection and access to data as well? Is this law connected in any way with the decree seeking to regulate taxation structures for digital companies? Some of the global names mentioned in conjunction with this law are Netflix and Apple, among others.
So they are completely separate, but they're all being used as a tool jointly by the government. Different means, different outcomes, but they are being used together. So Netflix, prior to this decree, Netflix was in discussions about taxation. They were trying to agree on a tax rate and how it was going to compliance, etc. And this decree makes it easier. But to do that, the government was arguing that if they don't do taxation, cybersecurity law would be applied and the implications. So we're seeing the use of it as a hammer and a stick. So that's not to say cybersecurity is not separate. So if the cybersecurity process, if you are selling in country and hosting and doing a whole range of things, you have servers in country and registered rep office, and you need to do that, which most aren't. And we've seen very limited enforcement of cybersecurity in a broad public sense. It's used as a tool. Now, that's not to say I'm not discounting the importance of cybersecurity and the government's intent there, but from a tax perspective and the purpose of this podcast, it is used as fairly much a sort of hammer and stick approach. We will go down the cybersecurity path if you don't come to the party on taxation. With this Decree 126, there's a clear path for the taxation, unlike Netflix was negotiating without clarity and kind of come to a rule. It's very clear now. So that if you don't, cybersecurity comes in. You may be prohibited from the country if, under cybersecurity rules, even though that was ultimately a tax matter that you weren't compliant with. And so we see them intermingling, different purposes, but they can be used together for the taxation means.
Banks and payment service providers are required under the new decree to carry most of the burden of withholding the tax from payments to foreign suppliers and reporting as well to the authorities in case of credit cards, for example. Do you believe this would be difficult to implement and monitor on a consistent basis?
Yeah, this has been part of the discussion and why the decree has taken so long to come out, because the banks have saying we're not a tax regulator, not a tax collector. So the banks have course issues, and the government relented and really simplified the process. So if a payment goes to an entity on the list, only then does the bank need to withhold. Credit card payments, they don't have to withhold, they just have to report. Now that mechanism is going to be difficult, but the banks are working through that. So it's not just a complete withholding of all payments to all digital, which was originally a full obligation. The banks only if they're put on a list. Even though it's past the 5th of December now as we're recording this podcast, we haven't seen a public list. I'm expecting it to be a public list, quite openly public. And then only then does the bank have an obligation. If you're not on the list and you're making a foreign payment, you still have to comply with the foreign contractor and tax obligation. So as a corporate, you will still have to self-declare foreign contractor tax, register the receiver as a tax recipient in Vietnam and do that as the paying party. However, if they're on the list, you can just say, bank, please pay this provider and withhold the tax. So you've pushed the obligation, but the bank has a limited scenario where they have to comply. So we are seeing the banking organisations, we're never happy with this. We're seeing pushback, but that'll work. I don't see this as being a roadblock. The earlier drafts was a significant barrier and was definitely pushed back, and that's. I think we've got to a point where it's a functional system that will work quite smoothly.
Some foreign digital players have already established a permanent establishment in Vietnam, a PE. How does this work, and what would be the benefit for this approach?
So some of them have done representative offices to represent, others appointed agents, and others would be simply doing a tax registration without having a PE. And there's a number of scenarios. If you're a very sensitive sector, you might want to have a PE to be part of the cybersecurity requirements and therefore sell domestically and just purely pay your corporate income tax and get credits for your VAT, etc. It may just be easier. There's pros and cons, and it depends on the size and scale and the margins of the business and what there is, whether that's cost effective. A lot of them in sensitive sectors would say, no, we just don't want to bring our product and be on within the cybersecurity law. This gives a mechanism to be tax compliant and separately negotiate or deal with cybersecurity and stay out of that because of the sensitive nature. So I don't think there's a single path that's the right way to go. And those who are doing it locally often just say, look, I'll just appoint an agent to sell for us. They can deal with taxes. Any sale that's via our website that involves Vietnam can be pushed to a local agent. And some will just say, no, we're just going to do it our own way. And if the bank start withholding taxes, so be it. We'll deal with the consequences. And whether they will deal with the negative implications of being on a blacklist and being announced as non-compliant, and whether the threat of being blocked. And one of the things I know that a number of large organisations worry about is that Vietnam, even though from an ad perspective is a lower percentage earning than most Western countries, it is large. In Facebook, it's top 10. In those sort of your Google ads, it is significant. Therefore, being blocked out of the market has implications. So there's no one path that works, and it has to be looked at on a case-by-case basis.
And Matthew, from your experience, what would be the recommended approach for these foreign companies then, so they can still create the margins that they were used to in the region, but also be fully compliant with the Vietnamese regulations?
It comes down to modelling. So if you can model whereby having a Vietnamese entity, having a Vietnamese agent, having a representative office, or just being a fully foreign registered tax compliant basis, tax registration and having a tax code, any of those might work, and it really depends on how you model it. And keep in mind that you're going to lose 10% of that, whatever you do. As soon as you're on that list, you'll lose 10%, or you'll be put on the list of owing the government money through the credit card disclosures. So that loss of 10%, does it make more sense to bring that onshore Vietnam, get a credit for what you're doing for your other costs, if there are costs? Can that work out? When your question about what is the recommendation, I don't have one other than model it. Do the modelling, understand the implications, and understand the other issues, the cybersecurity and whether it applies or not to your scenario, and that will give you the best position. And there is no one scenario that's better off than others. The easiest is just do a foreign tax code, a Vietnamese tax code for a foreign provider. That's the easiest, but it may not be the most cost effective. Again, model it and see what happens.
Matthew, unfortunately our time is up. Thank you for your practical advice on this very recent topic and significant for foreign investors active in Vietnam.
As always, lad, you're very welcome, and I enjoy doing these podcasts with you.
It becomes more clear that foreign online digital media and e-commerce businesses operating in Vietnam will have to make sure they align their regional strategy with the new provisions of the Law of Tax Administration and Decree 126. An assessment of their local structures would be advised so that their entities and cross-border tax policies are compliant and efficient. And many thanks to you, our listeners, for tuning in to Advancing Vietnam podcast series. For more information about this topic, please check out our publications on vietnam.acclime.com. And if you want to reach out to us for any additional details, feel free to contact me on LinkedIn or throughout the website contact details.